Revolu Group, symbol REVLO, on the TSX Venture. It is a self-licensed neobank having secured licenses in Canada, the EU, and the US. The company's flagship technology is Revolu Pay, an Android and Apple multinational payment app, and as well has interconnection with Visa. The app is aimed at the worldwide leisure sector and family remittance market, so it's pretty much just a payment transfer system, and the shares are currently trading at 30 cents, with the market cap being 57 million. The company only produced revenue of 91,000 Canadian last quarter and had a net loss of 440,000. The company is not pre-revenue, but it's in its very early stages, so you're looking at a very high valuation on any fundamental value. And is also unlikely to see any profitability in the near future. But they do have a cash position, a net cash position as it is, of 957,000 at the last quarter, and it's also raised an additional 229,000 from it's the CEO and the other board members executing their warrants, and it's been 229,000 from that. But it has been burning cash of 359,000 from operations in the last quarter, so it has a few quarters of runway if it didn't have any additional cash raise, but it's actively raising cash as it goes, so you're seeing a bit of dilution, about 9% to hold on to its net cash position at this time. The company does have a runway of growth due to the overall size of the payment market. It's in the hundreds of billions, depending on the exact sector and the exact market, but it has a ton of runway. We see these all the time. It doesn't mean they're even going to take even a tiny percent of these markets, but it is a runway. The company does have the advantage of being MiCA compliant in the EU, which is to do with the cryptocurrency market, and it claims to be the only one that has that compliance within the 27 countries. Following the collapse of FTX, calls for more regulations have occurred, which does put Revolu in an advantageous position. Despite being unprofitable, Revolu does have a chance of short-term returns, as it is looking to be acquired by an unnamed European financially regulated entity. The acquisition has passed the due diligence phase, which means the likelihood is slightly higher than the initial stages, and it is by no means a guarantee at this point, though. The company's price is currently trading on the expectations of a deal being made. Before the initial announcements of a potential acquisition, the stock was generally trading about at 20 cents or so, at the higher end 25 cents, but normally closer to 20 cents. Since the announcement of the acquisition, it is traded as high as 40 cents, so 100% premium from the pre-announcement price. So if the deal does fall through, you'd likely see an immediate fall down to that 20 cent level. Whereas if it does go through, you'd receive the currently undisclosed premium on top of the current price. So this is by no means a long-term investment at the current price. It is an event-driven trade on the potential acquisition. We stay away from these event trades. It is purely a trade, a gamble of sorts, even though if you do weigh the odds, some people will find these are worth it. But for us, it's just never worth it. That being said, the underlying technology does clearly have value, as there is interest, and it is a company to watch going forward.
Yeah, one other thing I noticed about the digital payment companies, there's quite a few stocks in that area, and they've pulled back a lot just overall, right? So it's not been a great space to invest. But there's a lot of companies at the top of that market that are still highly profitable. They're making a lot of money doing what they do. So I would look at those companies first if I wanted to get into the digital payment space. And before I would look at a company that's burning cash flow.
Yeah, I mean, it just looks like a lottery ticket, and you might have more fun just going to Vegas and putting your money down on black. I mean, because it's hard to have any
when you're in Vegas, though, right?
Of course,
yeah.
But we have no real way to analyze this company. The cash flow isn't there for us to look at the business. Revenues are still very small, and they're burning through cash. If this deal doesn't go through, I mean, they better start producing cash flow at some point, or they're going to have to continue to issue shares to, keep the lights on in the business going forward. So,
and they'll be issuing them at a lower and lower valuation, which to them
over
is a
time,
higher and higher cost. Or should I say to their current shareholders is a higher and higher cost.
Yeah.